Shares of Lehman Brothers falling today, even after the company reported fourth quarter earnings that fell less than analyst estimates. Are more credit losses in store for these financials? And will the Fed be able to control these concerns? Those are just some of the questions we'll ask our featured guest, Peter Schiff, president of Euro Pacific Capital. He says the U.S. economy is already in recession, and he feels that assets will continue to flow out of the U.S. and into other global markets. Plus, we'll be joined by Scott Brown of Raymond James to get his reaction to this morning's PPI numbers and to find out what they mean for the Fed's take on the economy. Joining us now is our featured guest, Peter Schiff, president of Euro Pacific Capital. It's great to have you with us for the next hour, Peter.
Great. Great to be here.
One of the more interesting stories we had today involved a company, Dow Chemical, another Dow,
right.
That is basically getting some money from a Kuwaiti firm, and there's going to be a joint plastics venture, another sign of a large investment coming overseas to U.S. firms. This probably doesn't surprise you based on what you've seen.
No, not at all. But I don't look at it as foreigners making investments in America. I look at it as foreigners buying up America. Dow Chemical is going to be transferring significant assets into this joint venture, and these assets are now going to pass into Kuwaiti control or ownership, assets that used to be owned by Americans. And unfortunately, this is the byproduct or the consequence of our living beyond our means. We've borrowed all this money. We're exporting dollars to pay for the oil that we import. The Kuwaitis earned all this money selling us oil, and now they're using the money they've earned to buy our assets.
Could you argue this is just a manifestation of globalization?
No, I mean, this is impoverishment of a nation. We're selling off our cows and our chickens, to buy milk. I mean, we're mortgaging the farm, and foreigners are repossessing these assets. And, this is how nations bankrupt themselves. We're selling off productive, income-producing assets to enjoy current consumption.
What if you would hear from the companies, we've got to maintain value for our shareholders. We want to make sure we're delivering on that front, and this is the way we have to do it.
Well, unfortunately, I mean, all the capital investment now is abroad because we're sending it there. We're living beyond our means. We wouldn't have to do this if we were able to pay for our imports with exports, if we were saving and not just spending everything, and we had a more productive economy. This wouldn't be happening. Americans would be using their international income to buy investments overseas. We would be buying up foreign assets instead of the reverse.
Do you think what we've been reporting on lately, whether it's this story today, the Kuwait venture, or Abu Dhabi, when we look at what happened with the banks, is this not really the exception to the rule? This will now be the rule?
Oh, this is going to continue, and I think it's going to get worse. And I think before it's over, I think foreigners are going to own the majority of the Dow Jones 30. Who knows? And a good chunk of the S&P 500. These assets are all going to pass from American hands to foreign hands, and this is, the result of what we've done. And it's an indication of a nation in decline and our falling standard of living.
All right, you have set the stage for what's going to be an interesting hour of conversation, Peter. We'll be talking in just a few moments. We've got to take care of some business.
Has ticked up a little bit as well, Ron, and that brings me to my question for our guest. How can investors really play the volatility? What's going to end it, or can they buy into it in any respect?
Well, I don't think it's going to end. I think it's just getting started, and I think there's a lot of downside risk in the market. I mean, if you want to trade that market, you can, but I think if you're an investor, you need to use any rally to get out. If you're still, holding U.S. assets, U.S. stocks, you need to sell. The market's going a lot lower. There's no end in sight to this credit problem. In fact, it's going to get a lot worse, not only in the real estate market, but it's going to spread into the credit card lending, into auto lending, and all facets of consumer borrowing. We're headed into a very severe recession, and, stocks are going to go lower. Earnings are going to be under pressure. Ultimately, interest rates are going to start to rise substantially, not just corporate borrowing rates, but the rates on Treasury bonds, and it's going to undermine the market, undermine the U.S. economy. So people just need to get out. The market's going down.
Peter, let me ask you, when you look at what's happening with the market here, how concerned are you about exactly the extent of the losses for the market? For instance, you say that we're going to have a severe recession. Is it going to last long? Are we looking at corporations unable to produce single-digit profits, even that?
Yeah, well, I think the losses are going to be enormous. I mean, the problem is that American corporations have earned a lot of money selling products to Americans who can't afford them. Americans have borrowed the money to buy these products, and we have trillions of dollars of debt, and the American public can't possibly pay it back.
What about those companies, though, that do a significant portion of business overseas? Why would they sell?
Well, I mean, those companies are still going to do well on their international earnings, particularly as the dollar declines in the short run. That's going to give an added boost to their earnings overseas. But their earnings here domestically are going to be diminished. And, you know, I don't necessarily think that the gains abroad are going to fully offset their losses here at home. Plus, as interest rates rise, I mean, that's going to undermine the value of those income streams because you have to discount those earnings by a higher number. And in general, in a bear market, and I think we are in a bear market, stocks are going to go down. I think people will lose less money if they invest in the multinationals than if they invest in pure domestic plays like the financials or the home builders or the retailers. But the best thing Americans can do is avoid U.S. assets entirely and invest abroad, where companies earn 100% of their income outside the United States.
When you say avoid U.S. assets, are you talking about all asset classes? We're just talking about stocks here.
No, everything. U.S. currency, U.S. bonds, real estate. I mean, U.S. assets are going to be devalued relative to assets in the rest of the world. Americans are going to be poorer because of the collapse of our currency. So American assets are going to be less valuable than foreign assets. So people who want to preserve their wealth and the real integrity of their income streams need to move their funds offshore.
So when you say collapse of the currency, you don't think that what we're seeing now is a temporary situation? You see a long-term ramification to the dollar? Let's say if we have a recession, that even if the recession ends, the story's not going to change.
No, I mean, the weakening dollar is the consequence of our irresponsible monetary and fiscal policies. You know, we haven't been saving. We've been borrowing trillions of dollars from the rest of the world to consume. We run enormous current account trade deficits. The government runs budget deficits. And meanwhile, our industrial base has disintegrated. And we're in trouble. And as a result, our standard of living is going to diminish, and our currency is going to go down. And the rest of the world that has been propping us up, that has been lending us all this money to consume, they're going to see a rise in their standard of living, particularly throughout Asia. You know, the problem is, you know, you've got all these people in countries like China producing all sorts of products that they're not able to enjoy. Instead, they ship them to us, and we get them. That's all going to change. They're going to keep their products, and we're going to be stuck with our valueless currency. All
right. You have very some strong opinions there, Peter. We're going to explore some of those issues a little bit later in the show.
The credit markets, we think, are getting worse, not better. There's still an enormous amount of inventory that needs to be worked out. I think there are some good credits coming to the market that have been pretty well structured. That may open some things up if the market's willing to accept the quality of those credits.
That was Scott Sperling, president of private equity firm Thomas H. Lee, saying that he expects credit issues, as you heard, are going to get worse, not better. We're back with Peter Schiff, president of Euro-Pacific Capital. You've got a similar view, Peter, that we're not seeing the light at the end of the tunnel. You actually talked about credit in your book, too.
Right. I know I wrote a book. It came out in February this year called Crash Proof, How to Profit from the Coming Economic Collapse. And in that book, I pretty much laid out the entire unraveling of the real estate bubble as we've so far experienced it. And there's a lot of other predictions. But I also wrote extensively about the problems related to consumer credit, which, you know, is really like a cancer in a free market economy. I mean, the worst use of credit is for consumption. I mean, credit comes into existence based on savings, and savings are scarce. And really what you want to do with savings is that you want that to be loaned out to businesses, to entrepreneurs, to invest in capital formation, which can raise living standards. You don't want people to borrow money to just go out and spend it to buy a television set or to remodel their kitchen. And the real danger, too, of those type of loans is they're hard to repay. When a businessman borrows money and invests in a factory or, you know, capital equipment, that investment produces an income stream which is sufficient to repay the borrowed money. But when a consumer borrows money and spends it, he has no way of repaying that debt unless he just reduces his future consumption.
Well, we have seen, for instance, credit card delinquencies on the rise. We're going to take a look at a graphic of that just to give our viewers a sense of what we're seeing here. What's interesting is while they are on the rise, they're still at a lower rising part, if you will, than what we saw earlier in the decade. So it's not as extreme as we saw
Well,
then.
it's going to get there. I mean, first look at auto loans are also at record delinquencies. But remember, one of the reasons that consumers have been able to handle their credit card debt is because they've been able to extract home equity. One of the biggest use of home equity extractions was to consolidate credit card debt. That option is gone. Most Americans have no home equity, whether they know it or not. Most real estate is worth less than the mortgages on the properties. And so they're not going to have that lifeline. And with rising cost of living, with energy costs rising, with food costs rising, with the cost of living going up, Americans are going to have increasingly difficult time paying their credit cards, and I think we're going to see a huge crisis. I think one of the big stories next year is going to be the blow-up in credit card finance, and I think you're going to see foreign lenders backing away from credit card securitized bonds, and I think you're going to see credit limits slashed. I think Americans are going to see get letters from their credit card companies saying that their limit has been dramatically reduced, and then Americans are not going to be able to buy things using credit cards anymore. They're going to be maxed out.
Interesting prediction. You know, we have seen, when we were talking about housing a little bit there, we have seen delinquencies there, of course, rise as well. We've been following that part of the story rather closely. But the question for you on the credit side of things, listen, if these companies are still making money, why would they take some of those steps? Because they're going to start seeing losses. They're not going to be able to package those loans, if you will.
Sure. And also, you know, the signals, the messages that we're now sending to the lenders with the mortgage crisis, with the bailout plan that, you know, Bush announced and Paulson, where we want to freeze payments on these loans, we want to try to further reduce the value of these securities, and we want to vilify the lenders and threaten the lenders by trying to hold them responsible for reckless borrowing. That's sending a chilling effect around the world for people not wanting to lend money to us anymore.
But of course, we did see the Fed come in yesterday with its plan. I just have some headlines on the Fed on our Bloomberg terminal I want to pass along. Fed redeemed $15 billion in Treasury bills to add flexibility. The Fed is redeeming maturing Treasury bills on December 20th. So again, the Fed is trying to pump that liquidity in the system. Wouldn't the Fed really be ready and willing and able to stand by to try to prevent some of these things from occurring?
Well, remember, when you talk about pumping liquidity, you talk about creating inflation, which is really all the Fed can do is create inflation. So they create additional money and they give it to lenders. I mean, what they're doing now is they're allowing some holders of mortgage-backed securities outside the United States to basically unload those securities on the Fed in exchange for cheap money that they can use to invest abroad. None of that money is going to make it back into the U.S. mortgage market. But in the meantime, the dollar is debased, and Americans here at home, working Americans, suffer because they don't get access to that cheap money. All they have to do is deal with the consequences of that inflation, which is a higher cost of living and a falling standard of living.
All right, Peter, sit tight for a moment. We've got to take another break. Up next, to check. Welcome. If you've just joined us, I'm Rhonda Schaffler. You're watching Bloomberg's Open Exchange. Let's take a look at how the markets are faring as we work our way toward the afternoon. At this point, we've got the Dow off 88 points, S&P retreats 13, NASDAQ down 25. Now we're going to check on some of the top stories we're watching for you at this hour. Lehman Brothers reporting fourth quarter profit fell 12% on write-downs stemming from the subprime market collapse. Lehman's earnings did exceed analyst estimates. Retail sales for November rose twice as much as forecast, easing concerns that rising energy costs and falling home prices would hurt consumer spending. Sales rose 1.2%, the biggest increase since May. And prices paid to producers climbed at the fastest pace in 34 years in November, pushed up by surging fuel costs. Excluding food and energy, prices rose the most since February. How will these inflation concerns affect the Fed's view on the economy, and how can we expect the central bank to act? For his thoughts, we turn to Peter Schiff, president of Euro-Pacific Capital, and we're also joined by Scott Brown, senior economist at Raymond James. He's in St. Petersburg, Florida this morning. Welcome, Scott. Nice to see you.
Nice to see you.
Let me start with you. Very surprising numbers on the economy, both with retail sales and producer prices. On the producer pricing side, is the Fed underestimating the inflation threat?
I don't think so. I think the Fed's clear focus is on inflation, but they're also worried about the credit markets, and the implication there is that growth will slow down into the early part of next year, and that should help keep inflationary pressures at bay. But obviously, for some of the more inflation hawks at the Fed, it's more ammunition for them to argue against a rate cut in the future. Now, a lot of the increase, about half of that increase in the headline PPI, was just the seasonal adjustment. It is normally, the seasonal pattern is looking for a decline in energy prices, and instead it got a pretty strong increase in both heating oil and gasoline, and so that effect was magnified in that headline number. The core rate may be a little bit more of a concern. That was up 0.4%, but that followed 2 months of very benign readings, so the trend there is still pretty moderate.
Well, remember, it's the Federal Reserve that's creating all the inflation in the first place. They're not fighting it. And what their main agenda is to try to confuse the public so that they don't appreciate the extent to which inflation is actually ravaging their net worth and undermine the value of their savings. I think, but by focusing our attention on the results of inflation, which are rising prices, they can create that confusion. But I think even the numbers that purport to represent inflation, I think, are still rapidly understating, the effects of inflation and how much consumer prices are actually rising. And I think it's going to get a lot worse. I think we're going to experience, some of the highest rates of inflation that this country has ever seen in the years ahead, and it's going to be combined with a very severe recession.
Let me switch gears just for a moment because I want to get Scott's thought on retail sales, because this is also an interesting story, Scott, in that if we're so worried about the consumer, why are those retail sales numbers so strong?
Well, it was a very pleasant surprise this morning. Certainly we had seen some good results from a lot of the retailers. You had cooler weather in November, which helped a lot of the apparel sales. You had a calendar shift. The earlier Thanksgiving added a couple more shopping days at the end of the month. If you look at the Commerce Department numbers, they tend to be a bit erratic. I mean, you'll see some very strong months followed by some soft months. And it makes it very difficult to sort of gauge the underlying trend. But on balance, if you combine this one with the last couple previous months, it looks like the consumers are still out there spending money, and that's a pretty good sign at this point.
Well, there's nothing good about consumers going deeper into debt to buy more foreign products. Our trade deficit, we came out yesterday, $57 billion. I mean, close to a record high. This is nothing to celebrate. This is creating more of a problem. And, a lot of the higher retail sales also result from the fact that things are more expensive now because of inflation. And I'm not sure what percentage, but I know there's a lot of people, a lot of tourists coming here with empty suitcases from Europe, from Canada, buying things at our stores. And so this is also goosing the retail sale numbers, but this is not a good thing. And again, this is not foreigners buying American products. This is foreigners buying their own products that they can buy cheaper in America than they can in their own country. And that's going to change over time, and we're going to see substantial increases in consumer prices in this country to stop that arbitrage from taking place.
Scott, as you can tell, Peter has some very definitive views on the economy. I'm curious to get your opinion based on the numbers we saw here today. What is your view on what's happening with the economy right now, and how much of a recession risk is there?
Well, I think the economy is in reasonably good shape given what's been thrown at it. It does look like growth is going to be below potential as we enter 2008. And there are important downside risks to the outlook. The housing correction could be a lot worse. The tightening in the credit markets could become worse. You could see a further increase in oil prices. But I do think the Federal Reserve and other central banks have been right on top of this. We saw an effort yesterday to provide liquidity to a lot of these banks that have been reluctant to borrow from each other or lend to each other. So, I still think there's a lot of hope. I don't expect a recession next year. I think the economy is likely to skirt it. But for the most part, it's a question of semantics. I mean, for many people, it's going to feel like a recession.
Yeah, I couldn't disagree more. I think the economy is a disaster, and I think we actually are in a recession. The only reason that we can't tell is because we're using government numbers. I think, the last GDP report, the government assumed that annualized inflation was less than 1% a year. That's just ridiculous. I mean, it's much closer to 10% than 1%.
Where do you get that figure from? I'm sorry to jump in.
Which figure?
Well, closer to 10%.
Well, if you can look at these shadow government statistics. The government changed in the late 1990s. They changed the way they calculate inflation. They introduced hedonics. They introduced geometric weighting, substitution, all sorts of things designed to make the numbers lower. If we were still measuring inflation the way we did in the 70s and 80s, it would be around 10% a year right now. So we don't have a growing economy. We already have a contracting economy, and it's going to get a lot worse. And I think by next year, even the government's phony numbers are going to show that we have a recession, but it's going to be far more severe than what those numbers show.
Scott, I would assume you don't agree on the numbers side of things.
No, I think certainly the inflation numbers aren't perfect, but they are what they are, and that is, the focus for the Fed is clearly on the underlying trends in consumer price inflation. Obviously, the inflationary experience is going to depend, significantly from individual to individual. But I don't think inflation overall is real at 10%. I think that's vastly overstated. Obviously, the energy price pressures are going to be felt, and there's some fear that could end up getting passed through into a wide variety of consumer goods and services. And I think the important thing to watch, and what the Fed's focusing on, is inflation expectations, because once people do expect inflation to pick up, then it becomes self-fulfilling.
Scott Brown, senior economist, Raymond James, thanks for joining us in this conversation. Appreciate it. Dollar's rebounded from its recent lows over the last few weeks. We're going to look at what's next for the dollar. Stay with us. We're back with Peter Schiff, president of Euro Pacific Capital. I know you're negative on all U.S. assets. We covered that in the last half hour. What about the dollar here? The dollar's slide against the euro and some of the other currencies has been felt throughout, not just within currency trading, but in many different areas. Tell me what is happening right now with the dollar that troubles you, that perhaps is something we haven't been reporting or talking about.
Well, the weakness in the dollar is a reflection of the underlying weakness in our own economy and the fact that we've had this phony economy for so long, and ultimately a discipline is going to be imposed on American consumers from our lenders and our suppliers, and they're going to impose a weaker currency on us. And contrary to the way the media covers this is nothing that we should be celebrating. This is not a benefit for us. This is a huge negative for America. And I think the dollar's decline is really just getting started. The 30% or 35% we've lost over the last 6 years really just offset the increase in the dollar's value that the dollar enjoyed from 1995 to 2000 as foreigners wanted dollars to participate in our technology bubble and the internet stocks and all that. But I think once the dollar index, which is an index a lot of people look at, really broke through 80, I think this shows a new leg down in the bear market for the dollar. And I expect over the next 2 to 3 years the dollar index to really be cut in half from that 80 level, which would put it down around 40. Yeah, and that's a substantial loss of wealth for Americans, a reduction in our standard of living. And I think the major risk is that the dollar's decline is far worse than that. If the Federal Reserve reacts to this and the government reacts to this through monetizing, if we have the chance or run a risk of causing hyperinflation in this country, in which case the dollar could lose 80, 90% or more of its value. And that would be far worse than just biting the bullet and suffering the consequences of the bubbles that we have already blown up in the stock market, in the real estate market.
But at the same time, we have so much tied to the dollar. China's currency, for instance, always a matter of debate. You have some very strong feelings there on what's going to happen.
Well, sure. Well, I mean, the Chinese are providing an enormous subsidy to the American economy, which in the long run, they're not doing us any favors. But in the short run, what the Chinese are doing is they're allowing us to live a standard of living inconsistent with our actual productivity. What the Chinese are doing is supplying us with low-cost products, and they're lending us money at low interest rates to buy them. So because of China, consumer goods are a lot less expensive and interest rates are a lot lower than what would otherwise be the case if the Chinese withdrew the subsidy. In the meantime, they're suffering as a result. They have their highest inflation now in 12 years, and Chinese consumers, who are far more productive than American workers, are having to do without products that Americans are getting for nothing.
Well, I just want to jump in here because I know that if you're listening to what you have to say, at this point you're thinking, where am I going to put my money? I mean, there's got to be something. And there is a positive to the global story. You do like some global markets. You do think that's where we should be investing.
Sure.
So I want to touch on that just a little bit.
I think what everybody is missing out, people look at the United States and they think we're the engine of the global economy. We're not. We're actually dead weight that the global economy is dragging along because we're just consuming and not producing and borrowing and not saving. And so we're not adding to the global economy. They don't enjoy our consumption. They're penalized. They have to subsidize it. And I think when the world allows the dollar to collapse, the opposite is other currencies rise. And the purchasing power that Americans lose doesn't evaporate from the planet. It just is transferred to other individuals. And so all the factories around the world that are producing products, they're still going to produce them. The difference is going to be who consumes them. It's not going to be Americans who are now poor. It's going to be wealthier foreigners who can do that. And once the world stops squandering their savings and lending them to Americans who basically blow the money on consumption, there'll be a lot more money to invest in entrepreneurial enterprises, in capital formation, in businesses. And I think the world's standard of living will rise much faster when they recover reclaim their savings for more productive uses.
I think, in fact, we can take a look. We've got a chart of net foreign transactions into the U.S. economy, which might be interesting to look at because for you it sort of drives home the thought here that we're continuing to see this influx of cash. Unfortunately, we can't bring that up right now, but the story that you're telling us is that you want to see a little bit of reversal there. You want to see the U.S. be doing what these foreign supporters do.
Unfortunately, too, the money that we're borrowing, we're not making productive use of that money. In the 1900s, 1800s, America borrowed a lot of money from Europe, but we took that money and we invested it. We built factories, we built infrastructure.
All sorts of things.
Right, and that enabled us to repay these loans, and we became the world's wealthiest economy because we had a free, low-tax, low-regulation economy with high savings, and we invested. But now it's the opposite. We're borrowing money from the rest of the world and spending it. We have no assets to show for it.
I know that you have a problem with the savings rate. We'll touch on that a little bit later after the break because I'm going to ask you at this point, why bother saving if there's hard to get any sort of return on your money? So think about that. We'll tackle that.
Sure.
We've got to take a quick break. We're back with Peter Schiff, president of Euro Pacific Capital, wrote the book Crash Proof. Peter, I said I had a question for you. That is, you're worried about the savings rate. We're going to show our viewers what that savings rate looks like. How are you supposed to save money based on what's happening in the markets right now?
Well, of course, we need desperately to dramatically increase our savings. But by definition, we can't save more unless we spend less. And, of course, that would mean a recession, which is something this economy desperately needs. We need to get back to a normal, healthy economy. We can't get from where we are, a borrow and spend economy to a saving, producing economy without going through a recession. But the government doesn't want that because during a recession, the incumbent politicians might not be returned to office. So, unfortunately, the Federal Reserve pursues policies that encourage even more borrowing and punish people who save. And this is why what they're doing is going to lead to disaster, because it doesn't make any sense. And unfortunately, I have to encourage all of my clients at Euro Pacific Capital who are saving to save in other countries, to save in Asia, to save in Europe. And so unfortunately, those savings do nothing to benefit the United States because we're making our capital available to foreigners. I would much rather encourage my clients to invest at home, but unfortunately, because of our government policies, I can't do that because they'll lose wealth.
Aren't you worried, though, that if the U.S. economy is in a recession now or about to be in a recession and is in there for a while, that you are going to see an impact on some of those other economies, whether it's Asia or elsewhere? Are you saying that there'll be enough to make up for the difference?
There will be an impact, but in general it will be a positive impact, not a negative impact. There might be a negative impact on certain companies, but I think in general the world is going to benefit from no longer having to bear this burden of American consumers recklessly borrowing and spending. It's going to mean a lot more consumer goods and a lot more capital for the rest of the world when we stop consuming so much of it.
What should we start producing? Let me ask you that. If we get back to producing, do we have a strong enough manufacturing base to do that?
Unfortunately, no. Unfortunately, it's disintegrated, and it's not going to be easy to rebuild it. This is a terrible disaster what's happened to this country. We have squandered our wealth on consumption, and we've allowed industries that we created and developed to basically be exported to the rest of the world in exchange for some temporary gratification so that we can consume things. But we've done this to ourselves. But
Let's talk about the Treasury market a little bit and who's consuming that, because we actually saw some interesting flow data coming out in the Treasury market. We're going to take a look at a graphic we have of that, basically of foreign inflows into U.S. Treasuries. And what we saw here was that outflow in August and September. This is when we started to first report that this subprime story was really unfolding. When you saw that happen, all right, were you concerned that, listen, we're now seeing some of these people make a run for holding American assets and American treasuries? They're not going to come back?
No, eventually they have to do that. They're already taking a huge hit on the foreign exchange losses. But I also think what's going to cause foreign holders of our debt to be increasingly concerned is when they look at the way we're handling this subprime problem and the way we're trying to basically vilify and blame the lenders and try to help out the borrowers at the expense of the lenders. I think that's going to raise a lot of eyebrows, and people are going to start to think, wait a minute, we own a lot of short-term U.S. government bonds. what's going to happen when interest rates really start to rise, and making interest payments on this debt really becomes a burden on the American economy and the American taxpayer. What is the government going to do? Are they going to default on these bonds? Are they going to change the terms? Are they going to turn these, one-year Treasury bills into 30-year Treasury bonds? I think people are going to get worried that rather than making sacrifices here, we're going to try to impose those sacrifices on the people who have been lending us the money.
We got take another quick break, Peter. We'll continue our conversation in just a moment. We'll get some final thoughts from our featured guest, Peter Schiff, president of Euro Pacific Capital. You're watching Bloomberg's Open Exchange, 51 minutes past the hour now. Welcome back. Peter Schiff, president of Euro Pacific Capital, has been our guest this hour on Open Exchange with some very definitive views. I'm very curious to hear your views about what's happening in the commodity market, since watching oil attempt to hit $100 was a big story for us not too long ago.
Well, it'll go through 100 pretty soon. We've been buying oil. I've been buying oil and oil stocks for my clients at Euro Pacific Capital since oil was under $20 a barrel. And I understood the reasons why oil prices were going to rise. And oil prices are rising as a direct consequence of the inflation that the Federal Reserve is creating. This is really not an oil story. This is a currency story, a dollar story. Currencies around the world, and not just the dollar, are being debased. They're losing value. Therefore, we need more of them to pay for oil. If you go back to 1970, gold was $35 an ounce when we were still on the gold standard. Oil was $3 a barrel. Now oil is $94 a barrel, and gold is $800 an ounce. I mean, if you look at oil priced in gold, the price of oil over the last 35 years in gold, which is real money, has only increased by about 20%, which means if we still had honest money, if the Federal Reserve had been defending the integrity of the dollar these last 35 years, oil would not be $95 a barrel. It would be $3.40 or $3.60 a barrel. The difference is all the inflation that the government has created.
You'd rather go back to the gold standard?
Of course, of course. I mean, we had, a much better economy back then. We had falling prices, and prices were lower in 1913 when the Fed was created than they were in 1880. And we had the Industrial Revolution with a gold standard. I mean, we became the world's wealthiest economy, the world's wealthiest creditor nation, with a gold standard, and the discipline that imposed on our federal government. Ever since we completely abandoned it in 1971, the government has no discipline whatsoever. They can borrow and spend till their heart's content.
Let me ask you about the commodities beyond oil, beyond gold, and looking at both hard and soft commodities. Do you invest elsewhere within commodities? Do you believe that we're going to see other commodities continue to rise because of the booming economies elsewhere?
Well, certainly. I mean, I think, well, first of all, inflation is being created around the world. So as a result, prices are going to rise for that reason alone. But one of the reasons I'm so bullish on commodities, I think once the Asian economies, particularly the Chinese, allow the dollar to collapse, and they start focusing more of their efforts in production on their own consumers and satisfying their desires and their needs, I think the composition of their production is going to change, and I think it's going to be a lot more resource intensive. And so I think the Chinese are going to use a lot more aluminum, tin, steel, energy, producing stuff for themselves than producing stuff for us. And so I'm very bullish on those commodities, and I do think that over the last decade or two, I don't think the world has invested enough in capacity, in exploration and development of these resources.
Well, see, now with oil, obviously, I mean, that's part of the story here.
Mm-hmm. Oh, certainly, and that's also one of the reasons we haven't, we've spent too much of our resources investing in telecommunications and technology. We forgot about these basic other goods that we need, and so I think they're going to be in short supply, and I think they're going to continue to be good investments for people who are in that sector.
All right, you still have your win buttons at home? You might have to dust those out.
Well, they didn't work before, and they're not going to work now. Inflation is not a function of psychology. It's not created by businessmen or consumers. It's created by the government. It's created by the Federal Reserve, and no one else can stop it but them.
Peter Schiff, it's been a fascinating hour. Thanks so much for being with us.
Thanks for having me.
Coming up on tomorrow.